Aviation is safer today than it has ever been. Modern commercial aviation boasts an accident rate of approximately one fatal accident per 16 million flights, far lower than historic numbers. Do you know why has flying become so safe? There are two black boxes on the aircraft. One records mechanical information, example fuel levels. The other records sounds in the cockpit, including the pilot's conversations. During accident investigations, these black boxes provide holistic, unbiased information to reveal what happened so that corrective measures can be taken to prevent future accidents. The pilots are typically rewarded, not penalized, for reporting mistakes. Accidents are investigated in depth and insights are shared throughout the industry to facilitate learning and improvement. This is summarized as an open loop system in the book Black Box Thinking, where failures are seen as a building block for success. In the investing parlance, information sharing about what is happening inside the cockpit or the insider activity has helped make flights safer. Unfortunately, such insider indicators are often ignored in the world of investing, and therefore stock market crashes are commonplace. Take the case of IndusInd Bank. In an interview to CNBC, the CEO of IndusInd Bank attempted to explain the bank's lapse of corporate governance in reporting discrepancies in derivative transactions. He said, "I continue to believe the bank is fundamentally very strong. Yes, we've had our hiccups, and the hiccups have not left us. The treasury thing has been a big blow personally to me also, but I think it's a matter of time that the bank will come up, and I don't think there are hidden skeletons in the cupboard. And we are not hiding any losses or we are not hiding anything from the investors. There's absolute transparency in the system, and if I can come and disclose a number before I knew the final number, I think it would tantamount that we want to be transparent to our investors and to the media at large. And I don't think there's a view that we want to hide anything from the market." Now, having said this, the problem is that the CEO's speculation of more skeleton in the cupboards was not without reason. In December 2024, the RBI had levied a monetary penalty of Rs 2.7 million against IndusInd Bank for non-adherence with deposit interest rate guidelines. The RBI was of the view that the bank had opened savings accounts for ineligible parties and in doing so had violated guidelines. Further, RBI had restricted the appointment of Sumant Katpalia as Managing Director and CEO for a term of only 1 year. This was against the 3-year tenure proposed by IndusInd Bank's board. The regulator cited dissatisfaction with the bank's risk appraisal process for the early change in management. To top these, there had been significant insider selling of shares amongst the top management of the bank in 2023 and 2024. Such information is typically disclosed to the stock exchanges. Of course, one could argue that such warning signs are more visible only in hindsight. But it is important that investors be wary of specific insider indicators that could alert them of corporate governance lapses. Here are 7 indicators of insider activity that should not be ignored. First, use of derivatives and risky financial instruments. Ever since the financial crisis of 2008, derivative instruments have been regarded as financial weapons of mass destruction. Hence, entities that go overboard in trying to profit from such instruments are bound to have their risk management policies questioned. The role of auditors. The role of auditors truly came under spotlight when a Big Four audit firm, PwC, was found guilty of shadowing the massive corporate governance lapse at Satyam Computers in 2008. The story repeated itself in 2018. While auditors were to play a crucial role in pointing red flags, they chose to turn a blind eye to some frauds. And when matters got worse, the auditors resigned. 32 auditors had resigned between Jan and May 2018. The number may seem minuscule given the quantum of listed stocks. However, what was alarming was the rationale of the resignations, which weren't in the normal course of audit contracts. Auditor resignations have especially been a warning signal for small caps. Lack of transparency. The greed of fast growth often leads managements to diversify into unrelated businesses, leverage balance sheets, undertake huge capex, or buy out businesses at steep valuations. Such misallocation of capital can be a drain on shareholder returns. However, managements tend to deny such misallocation of capital instead of being transparent in sharing the possibility of lower returns with minority shareholders. Expensive acquisitions, foray into unrelated businesses, etc., need to be questioned for the transparency on behalf of the management. Quality of assets. The absence of an external auditor during a concurrent audit on IndusInd Bank's mark-to-market derivative losses has put the spotlight on a process gap that might not be limited to the private lender alone. In IndusInd's case, although the treasury transactions faced internal scrutiny, there was no external examination of the trading transactions. External scrutiny could have exposed the bank's treasury to questions on its hedging positions. Such regular audits can also point to vulnerability of the bank's asset quality and give warning signals before the loans become unrecoverable, which are called non-performing loans. Given how vulnerable the bank's return ratios or return equity are to the rise in NPA and the depletion of net worth, not keeping check on the slippage of asset quality and treasury book is as good as the management's disregard for shareholder interest. Solvency of the entity. In a banking entity's loan portfolio, NPAs impact operating performance, which in turn disturbs the profitability, liquidity, and solvency of a bank. A bank that sees a sharp deterioration in solvency, which is calculated by the capital adequacy ratio, could even witness an embargo on deposit collection, lending, and cash withdrawals in extreme cases. The promoter pledging. Share pledging is not an illegal activity, but you need to keep your eye out for companies with questionable managements. This is because over-leveraged firms with high percentage of pledged shares could very well turn out to be very poor investments. If the company fails to repay and the lender decides to sell the pledged shares in open market, then the promoters will only be left with a minority stake in the company, risking losing control over the company. Finally, contingent liabilities. As the name suggests, these liabilities turn real only when the event that they are contingent upon does so. They are not a part of the balance sheet in the normal course of things. However, they must be taken note of if they account for a large part of the company's net worth. For if they turn real, they could land the company in serious trouble by wiping out a huge chunk of its net worth. By themselves, these parameters may not yield much information about the quality of financial reporting of a business, but combine them and you could well be onto something. To conclude, the insider activities may not be the exact sign of weakness in a stock, for often insider selling of shares could also be about the promoter's need for liquidity. However, the indicators are certainly a checklist that investors could consider evaluating before buying value stocks. For instance, while most investors were wondering if IndusInd Bank was an attractive value buy after its correction, the question left to be answered was whether the bank's net worth is now sustainable. Without adequate assessment of its books and regulatory scrutiny, judging the bank as a deep value stock would have been a big mistake. More importantly, entities that fail to uphold corporate governance often tend to lose premium valuations for a prolonged period. So do not rush into buying value stocks without running this checklist. Hope you like this video. Thanks for watching.